Starbucks isn't a true triple net. It's actually a double net plus. The great thing about when you do a corporate guaranteed triple net is that that corporation actually guarantees the lease. We have basically bought everything cash in the past 18 months.
Greetings, well builders. Welcome to Get Diversified, your go-to podcast for all things real estate investments.
I'm Jacqueline.
Melvin Landry. We're thrilled to embark on this wealth building journey with you.
Imagine this. What if your investments not only secure your future, but also unlock a life of financial freedom? That's what we're diving into on this show. Apartment buildings, storage facilities, mobile home parks, the whole shebang.
But here's the kicker. It's not just about investing. It's about crafting a legacy, building memories with your loved ones, and seizing every moment. Time is the currency of life. And let's be real, none of us wants to waste.
We've got the insights, experience, and dash of excitement to spice up your investing game. Plus, we'll throw in some real-life stories that'll make you see the potential in every brick and mortar.
Subscribe, buckle up, and get ready to turn your investments into the ticket to financial freedom. Together, we're not just building wealth, we're building the community of savvy investors. Let's get diversified.
Good morning, everybody, and welcome to Get Diversified. I'm your host today, Jacqueline Landry, and I am here with this phenomenal individual, Julie Roy, who is not only a friend, but somebody that is very trusted in the real estate industry. She is an entrepreneur in real estate, and she lives passively on real estate investments. And I'm going to let her do the rest of the talk about introducing herself today. So, Julie, welcome to the show.
Thank you, Jackie, and sorry for the technical issues I had this morning. You were so patient with me, so thank you. I always love coming on the show with you and sometimes with Melvin too. But yeah, thank you so much for having me, and hopefully I'm going to add some value about doing some diversified investments for your folks. And so, yeah, just ask all the questions, whatever y'all want to know. I'm happy to help you with.
Fantastic. So what I really want to talk today about, Julie, is triple net and why triple net investments are so important. So my guess is that a lot of our users don't really know what that means when I say triple net. So let's kind of walk through the whole process of what that actually means.
Okay, so I'll give them a little bit of an idea first and foremost why we went with triple net, because I think it's important to know where we came from and sort of why we went with a triple net decision. So we have something called a trifecta strategy we use for investments. So we use the triple net, which will explain what that is, for active income for us. So we live off the income that comes in from the triple net because it creates a consistent cash flow that we can rely on. We use multifamily, which your folks know quite a bit of, I'm sure. So we use the multifamily to eradicate the tax of the triple net investments capital that we receive. So when we get cash flow in, we sold our businesses, and so we needed to replace that active income, right, with something that we could live on. And so we needed something to make sure that that cash flow was coming in monthly. And so but we didn't realize that, at the end of the year, we'd have a huge tax bill. And so that's when we started to diversify into multifamily because we were able to eradicate the tax that way. And then we do have a small portion of the triangle that basically deals with things that are a little more long-term or have a higher IRR, sometimes a little higher risk, but we do want that for our portfolio because what also is important to us is that we're having different capital exits with our investments. So with our multifamily, you're having that 3 to 5 year. With your triple net, you can have anywhere from 3, 5, 10, 12, depending on how you structure that. And then the storage, industrial, car washes, fractional business ownerships, things that we do in that other corner are different exits and different plays as well. So with triple net, basically triple net means you're a landlord for a tenant. It could be numerous tenants, but we focus on a one tenant deal. And that tenant pays everything. So triple net means they pay insurance, they pay taxes, they pay repairs, they pay maintenance. You pay nothing. You get a check in the bank, ACH to us every month, and that's it. So there is something called double net, and a lot of the folks that we use also do that. So for example, Starbucks isn't a true triple net. It's actually a double net plus, which means you have responsibility for the roof and the structure of the building. So What we do, though, to mitigate that is we buy brand new. So we buy brand new with warranties, and we buy direct from developers. So we're mitigating any risk that has to do with new, with roofing or structures or things like that, because you're getting it right directly from the developer. And now we've created these relationships with a developer that they're just calling us saying, hey, Julie, we have a new Starbucks in this area. Do you have any folks that are interested? Would you like to syndicate, or would you yourself like to just buy it for your own portfolio? So we have a large portfolio of triple net assets that are just ours, Bo and I, so my husband and I and our families. And then we have another portfolio that we syndicate. We never thought about syndicating triple net. And people kept asking us, Julie, like, we see you get a cash flow every month. We see this working. How can we also become a part of this? The challenging part about owning triple net or double net like Starbucks is that you have to have quite a bit of capital to place when you want to buy them. So initially, the big blockage, I guess, for folks to own triple net, especially one tenant corporate guaranteed triple net, was that they had to put a lot of capital in. When you can syndicate, they're able to put less capital in and still be part of the deal, also mitigating their risk. So that's a long answer. Hopefully it wasn't too complicated, but the other part of triple net or double net is that we do something called corporate guaranteed. So we work with high-level tenants like Starbucks, like O'Reilly's, new Taco Bell. We have a bunch of different dollar stores, different corporate entities. The great thing about when you do a corporate guaranteed triple net is that that corporation actually guarantees the lease. So what you're buying is the land in the building when you're a triple net owner, when you're the landlord, and the people who are inside renting from you, the tenant, has a corporate guarantee. So for example, if I bought a Starbucks, and I did right now, just half a mile down the road, because I frequent it every day and thought I should help my tenants and pay for my Starbucks issue. So what we did is we bought the Starbucks down the street. It was brand new in construction. I was able to contact the developer. The developer had actually left me a message, and I didn't realize that that was the Starbucks he was chatting about. And we drove by with the kids, and I was like, well, this is like a half a mile from my house. Like, we could definitely go here every day. Anyway, so we bought that Starbucks. And why I did was because even if Starbucks decides, hey, guess what, Jackie? We don't like this spot anymore. We're done. We don't want to be here anymore. The initial lease is 10 years or 12 years. They have to, by law, pay you for the entirety of the lease unless Starbucks goes bankrupt across the entire U.S. So
Wow.
mitigation is really solid with the triple net. The other thing is that even if they decided to move, you, like me, we know the areas we're buying in, right? Location is key. So we always buy where there's a high VPD, vehicle per day traffic. Don't you think that even if Starbucks goes across the street and they want a different side of the street or whatever, because usually they'll stay within, a couple miles, they would still have to pay me. And I, the landlord now, can just get a Dunkin' Donuts or someone else in the space, right?
Yeah.
So there's always another tenant that can come in if you need it. However, you are guaranteed at least the initial lease. All of our leases are 10 or 12 years to start with, and then they always have what we call extensions, and the extensions are usually about 5 years. So this one currently has 20 years, 10, 5, and 5, and they have the option to do more. The other great thing about triple net, I'm trying to remember all the things for you guys, is that we have a rent guarantee, which you don't have, right, with the multifamily stuff. It's really not affected at all by market. When you receive the developer's certificate, we get something called an estoppel certificate, which guarantees you the rent that's coming in from that triple net, and that's going to now be your tenant, right? So the ownership transfers to you. What you buy is the lease, right? In that lease, you have every year those rent escalations. And that is not a negotiable every year. That is exact. So we know that every 61 months, Jackie, on these Starbucks, you will have a 10% increase. So 2% is factored in yearly. And at 61 months, that 10% is given to you. So we already know the rent escalations are combating inflation, which is something that creates security for us, because what our biggest issue was, we have some risk tolerance, but we cannot have risk tolerance with our daily living. So because we had to replace our active income, we needed to be sure that we weren't fluctuating, not getting paid at all, or months without payment, or quarterly payments. We needed structured monthly rent payments that we knew we could rely on. The last piece that I can tell you about triple net or double net or whatever you get into with corporate guarantees, the triple net portfolio or the triple net, aspect is that we not only have the ability to have all this cash flow, what we have done the past year and a half to mitigate any extra extraneous issues, we've done two things, actually. I'll tell you. One first is that we have basically bought everything cash in the past 18 months. So myself and our investors buy this Starbucks up front, right? We buy it cash. There's no bank involvement. There's no financing. So again, an increased risk mitigation tool for us has been, we don't have to deal with rates. We don't have to deal with anything. So we are owners day one. So day one, we get a full rent check and we don't owe anything to anyone. So there's no mortgage payments. There's no nothing. So that makes it really attractive for folks that want ownership of a land-based or an investment-based asset, right? Like a land-based asset. So you're basically trading your investment for real estate, and that real estate is owned by you day one. It's not like partially owned by the bank or partially owned by private equity or it is owned by the 10 or 15 people we have in that deal. Starbucks, we usually have 10 to 12, sometimes 15, depends on, if people want to get started maybe with a less amount. But normally it's a really intimate group. We love that because we're able to create a white glove service for our investors. And so we really love that intimacy, that conversation, that they're getting paid those monthly rent payments. I think most of our investors, and you're in one of them as a triple net,
Right.
can say that we're very transparent and we're giving money, and every money, it's in the bank, and you're not wondering where your payments are. We're communicating. The other thing is there's really not a ton of financial reporting because unless they leave, there's no change. So every month we get the same exact payment, and then once a year our accountant will just verify that everything that came in was paid out and or what it was used for, so that our investors have all that access. But it's fairly simple. What is important is in the beginning there's a lot of due diligence. So before we actually go to the investors or go to our group and say, okay, we have a project, we have to do a lot of things that you don't have to do in the multifamily world, or different than the multifamily world, I would say. So we have to have an ALTA survey. We have to make sure that there's no easements running through our Starbucks that later can come back and say, hey, we're going to, half this building now. So there's a lot of things on that and that we do just to mitigate a lot of that. We have to make sure the estoppel certification is verified. We have to make sure all the work is done in the building, that the tenant is happy and ready to sign off on occupancy, right? There's a lot of things that we have to do to mitigate that. And then one other thing I was going to say about mitigation is if we can also get a first right of refusal. So we did a TLE in South Lake, and that was a childcare center, a corporate childcare center, and they have a guarantee. Now, what if the corporate center says, okay, we're going to move this to a franchisee? Because that's possible, right? When you're a corporate-owned center, especially if you're franchised. Starbucks is not franchised, so there's not that worry. But when you do have a franchise, we also add in an extra component if we can. Most people don't allow this, but they actually allowed us to have a first right of refusal on the operations of the business. Well, childcare was my first love, right? Which is where I came from. So I made sure that we had a first right of refusal, or at least we could choose if they decided to get out and put a franchisee in, that we had control over that, or we could buy it. So there's some things that, you can add on and do just to increase mitigation. But we're very anal about ensuring that all of the T's are crossed and all of those I's are dotted to ensure the best possible situation for all of us.
Wow. I love that. And Julie, that's why Melvin and I invested with you on the triple net opportunity that you had or that you have in South Lake. So we love that, and what great information to have. So what about so I know in multifamily there's tax benefits associated with it. Are there any tax benefits associated with triple net?
So they're definitely not as strong as multifamily because often in our situation, especially because of the corporate guarantees and buying new, right, there is less value add, right? So as you know, also there's value in the debt, right, for taxes. And so because we are buying with no debt, that also kind of puts your tax, I guess, benefit a little bit lower. So we're averaging, maybe 10 to 20% of a tax benefit for your investment rather than, let's call it maybe 30 or 40 in multifamily right now. There was a bigger disparity, which is why we ended up using that multifamily, right, in our trifecta to erase sort of the eradication of our income. There was a larger disparity between what we were getting and what multifamily was getting in 2021, 2022, because of the 100% depreciation, then the 80% depreciation. Now that it's 60, we're definitely closer. Like the gap has definitely closed up. For two reasons. One, because the more you raise, obviously, the less there is for tax sharing, right? Tax benefit sharing amongst your investors. So, we raised all of it, right? So we're not all of it or put our own money in. And so there's no bank loan for us. When you have a 60% raise and a 40% bank loan, the max depreciation you can receive is a 40%, right? You know that. So now that banks are requiring 60 to 75% leverage, your ability to create that 80 or 100% tax break for your folks on the multifamily side isn't happening anymore, right? We're seeing more like 30s and 40s. So what used to be a huge disparity for triple net and commercial investing in that side of things the gap has really closed over the past 12 months due to the interest rates and due to the banks' sort of insecurity on lending, right? And so the lending got more tight, the depreciation got less, right? And so that has somewhat helped us in the triple net, but it has hurt us from a tax perspective because we were really relying on the multifamily to eradicate that tax. So we had to do a lot more investments last year to get the same amount, right, as we did the prior years. And so that will be, I think, the case this year as well. And then as we move forward, unless we have a government switch or somebody that wants to put in place sort of that depreciation schedule again, we're nearing the end, right? So we're next year we'd be at 40% of whatever the depreciation is. So when people say, oh, but I can get 60% with multifamily, well, you can, but you won't because it's 60% of whatever you're receiving. Right. So if it's 60% of 40%, now you're at 30 or 28. This is getting a little into the weeds, but it's much more comparable now, which is good and bad, right? So it's good for folks that, that want more like that, you want to be closer in leverage, but it's bad because we really now don't have the eradication that we had on the multifamily side. So we're just having to do more investments to get the same tax write-off, if that makes any sense.
Yeah, for sure. So what about the upside of when you decide to, exit the investment or sell or whatever?
Yeah. So the things about triple net is that our own portfolio, we probably won't exit. Okay. We'll hold. So we love holding because those rent bumps happen every 5 years or every year for the length of your lease. Some of our leases are 20 years, right? So, I mean, if we were in it ourselves, we would hold probably most of the time because there's really no reason to get out. But on an investment side with investors, they don't want to hold their money technically sometimes that long, right, in an investment. So what we have offered is basically there's two components that we would activate for the highest level of return for the investors. So one, obviously I could always refi and pay back the investors their equity plus their multiple and keep the building, right? That's option one. Or they could come back in with less money, right? That's option two. Option three is that we sell at 61 months or 5 years plus 1 month, which then we would activate the 10% net operating income increase, right? So now the lease is worth more, that which automatically appreciates your investment. Plus, we generally try to do that with a cap rate compression. So between the cap rate compression and the timing of the rent bump, right? That's when you would get your optimal. But however, the way things are going right now, rates have been, kind of fluctuating. We're hoping, and most people are predicting, because I can't say we don't know, right? But a prediction is that we will end in rates of, they're saying 4 to 5 by the end of the year. Even if we get to a 5, we've already created almost a 1 full percent rate differential. It may be worth it to sell even before the rent bump, because if we can get a cap rate compression of 1 or plus more percent, we could be $1 million to $1.5 million, up. And so then we would share that proportionately with the investors. So it really is us managing the market, watching, what's happening in the triple net space. Many people right now are buying, like we bought at a higher cap rate than we were buying on our own investments, because we bought when the cap rates were really, really fierce, right? Like they were getting really good money for their developments. Now there's more inventory, so we're able to buy at a higher cap rate. So even I think right now is an optimal time for us to continue to buy, especially cash, because we can do whatever we want. That's the great thing about buying cash, is you're not bound by any parameters, really, right? We are in control fully of the market, of the money, of the time of sale, of anything. I mean, our investors are with us, but we are really watching like what is the best exit for everyone. And it could be a refi. Like if we do get to points at 4, we could pay everyone back plus equity, plus we would still all own it, right? And it might be worth it. So it really will be a play of what's happening with rates, what's happening in the market with compression, and what's happening on the rent scale, which we already know when the rent scale is happening. So, but it doesn't mean we have to wait till then, especially because we don't have any debt on it. So it makes it really, we just have good positioning, on our investment.
That's awesome. So how often do you look at the exit, and is it the right time? Do you do it on a quarterly basis? Do you look at it every year? What's your time on that?
Look at it monthly. Look at everything monthly, like how the market, actually, we're looking at it really every day, but monthly we would evaluate, okay, what are we at with cap rates? How are we looking? Because we know when the rent bump is, right? Like we know for all of our portfolio, Bo has a huge Excel sheet and he knows like exactly what we paid and what we would need to get the equity. Now, if we promised, like, let's say not promised, but let's say we projected 1.5 times on something and we were like 1.4, and then all of a sudden there's a rate cap, like compression, or a cap rate compression. So now we're like 1.6, we might trigger for sale, right? Earlier. And it would not put our people at any capital gain pull or trigger, because what we would do is offer another investment, right? We would just get into something else that's new at a higher cap rate so they could, reinvest if they wanted to. Most likely that won't happen really quickly right now, just because we do need some rate changes, right, to happen. The other thing people don't understand is when you're buying triple net, if you're buying at, let's just call it a 5 cap, because it's easy. It's, kind of what everyone's, goal was to buy at. If you bought at 5%, right now the debt is at like almost 8% or 7 and change for. So you would be negative 2 or 3% upside down. So you really can't use debt right now to buy triple net, because it doesn't make any sense. What makes sense is if you buy cash, then you have full advantage and the rates are going to be changing, right? And even if they don't change, it doesn't affect your rent. It doesn't affect what cap rate you bought at, right? So we are generally just in a much better position. That's why I have a hard time, honestly, with multifamily sometimes, because it is more variable for me. So I'm like, always like, well, where's the cash flow? And it's not coming this way. Like, I'm used to having this really steady cash flow that, because it is our income, I can't be super risk adverse, but I need the multifamily and I love the equity play and I love so many things about it. But it was really hard for me to make that mental transition like it is for folks that are in multifamily to come over to triple net. They say to me, this doesn't make any sense. It's too easy. Like, what do you mean you get paid every month? Why? Like, how come it's so easy?
Right.
That is really the biggest thing that I get every time I take out, a deal, or we go to new folks that were in the multifamily space or the storage space. They're like, yeah, but like, where's the pro forma? I'm like, you don't need a pro forma. This is the rent. Here's the lease. Like, we can prove the lease, right? But even with a Google link to the lease, even with access, all the things, it seems almost too easy because multifamily has so many more moving parts. Rent, vacancy, you're performing to all those things. We have a corporate guarantee. We don't have to do a pro forma for vacancy. If they leave, they have to pay us. If Starbucks goes under in the entire US, we have more than a problem with our rent, obviously, right? Like, so
everybody would be going through withdrawals, Judy.
Well, if we're at that point, we got real big problems, right? Like, I have real big problems because I'm lying to Starbucks daily. But do you know what I'm saying? So my biggest thing is that obviously, just mitigate, and like prepare for exit. Obviously, those are the things, the risks, the things that are, I guess, the challenging parts of triple net. But in general, the rent predicts your monthly income. So that doesn't change. It's constant unless something happens to the company. People are like, well, Julie, that's a lot of risk. Like, there's only one tenant. Right. So if Starbucks goes under in the entire US, I do think that we're going to have bigger problems than our building that's paid for, that we own, right? We own the land, we own the building. I don't know, like, what could be less riskier. And yes, stuff can happen. Like, yes, companies can go bankrupt, but like the TLE you're in, right? That's the learning experience in South Lake. It's a corporate childcare center in one of the best pieces of real estate in the US, literally on South Lake Boulevard. You can't even build there. There's nothing left. If something happened, one, I have first right of refusal on the business. So guess who's owning some new childcare centers as well? But if we didn't and we wanted to sell, guess who I would go to? I would go to their competitor. I would go to KinderCare or other large corporate entities that would love to be in South Lake, right? So you just have to pay really close attention to location, which in any real estate, location. Like, Grant is my coach. Everybody says this all the time, but it's location for all those reasons we mentioned, right? Mitigation obviously is huge. The more you can mitigate against things, the more you can prepare yourself against anything that may come about, the better off you are, right? So with these type of leases, there are lots of check the boxes on mitigation because there's really no variables. So that's why we like them. And that's why we're triple net lovers. And we own a really big portfolio for ourselves as well, because it has, we are making, net about $1 million from triple net a year. So we're at home every day. My husband was a doctor. He closed his practice. We were serial entrepreneurs. Obviously, we had capital to inflect, because people are like, well, how do you start? Well, you need money to start. Okay. Everybody, this doesn't just happen overnight. We had to invest money that we had made from a business. So you do need a point of contact. You need somewhere to make the income to invest. And then once you have that, you can choose sort of from many areas. We chose to focus on this trifecta strategy that worked for our family because we are older. I'm 50 this year. I just turned 50. My husband's 51 or two, I think. Yeah, 52. But we have children in college. Well, college costs money. We want to live the same way. We didn't want to have a change in our lifestyle. So when you exit a business, a big portion of that is working backwards and finding out what do you need. Or when you exit, a job or W-2, what do you need to live? And are your investments able to cover that? And so for us, we are a little less risky because we need that money to live, because all of our money is invested in real estate, right? We don't keep a ton of cash because cash in the bank isn't giving us $1 million net return a year. And so our strategy has always been invest in brick-based assets. We don't do crypto. We don't do stocks. We have nothing in IRAs. We have no 401ks anymore. We've liquidated everything into real estate because historically, even if real estate does this, it always does this again, right? You have white caps that they call valleys of death, but you're always coming back up. So if you keep it long enough, you will eventually create appreciation. And so something that can't be really said in the markets. And we just feel like we have more control over our money.
Wow. I hope our viewers were actually taking notes. If not, you can replay again so that you can hear Julie with all these great tips and tricks on things to think about if you're getting into the triple net investment class. So Julie, thank you so much. You have been amazing. And I'm going to go through and watch this again so I can take some additional notes. But we love you. We love what you're doing. And I understand that you have a coaching program. So can you tell the viewers a little bit about your coaching program, and we'll end with that?
Yes. So one, thank you very much, Jacqueline, again, for having me on. Love you. And Melvin and little Melvin. I always watch all his stuff. So he's awesome. I love how you're raising your kiddo as well. That's a huge part of, who we are and who we associate with is, people that have the same mission, vision, values. We think it's really important. So kudos to you both. I love what you're both doing. I watch everything you're doing. So secondarily, yes, we have a coaching program. We coach high net wealth business individuals who want to scale or platform their businesses for either exit to private equity or for platforming for legacy wealth. Either way, we are looking to create legacy wealth or help folks create legacy wealth. So there's really 3 pillars, sort of investing in a business, learning how to run the business to scale the business so that you can kind of pull out some time out of your business, get income to invest, and then use those investments in various asset classes. We normally do not lead the role of the multifamily GP. We are a GP, we are co-GPs, but we never lead. We just don't have what we feel I don't want to say that, I don't know, it's hard to explain, but we don't know as much as we know about the triple net in the multifamily area. And so we leave it to the experts who have been doing this for a long time. We will help, we'll get in, we love it, we want to be a part of it, but we don't lead the programs in the sense of like doing the due diligence, finding the locations, things like that. We actually partner with folks that have been doing that. If they have obviously vertical integration, that's best. If they don't, that's okay. But we love to do that. It's just not our primary. So one of those 3 investments normally our folks will come into. So we help people build, scale, basically invest, and then create, hopefully, monthly recurring revenue or income for themselves. And so our program is called Wealth Masters. We only take 12 businesses a year. So we've been full for 24 for a while. We're taking a wait list for 25 currently. So it ends up being about 24 high net wealth business owners. And we talk about all the stuff we've been talking about today. So investments, families, employees, scaling, people, execution, strategy, right? All of the things that we need in all of our businesses, including real estate investment businesses. So, but yeah, so that's what we do. And besides that, we mom and dad 4 kids. so it's a little crazy and busy, and we love to travel the world. I think, Jackie, we just finished our 7th continent with our kids. And so living our dreams as a family has been super, super imperative and important to us, and always, always leading with our heart, with integrity, and with authenticity. And so we hope to continue to do that for many more years to come.
Fantastic. Well, thank you, Julie. I appreciate all your insights, and your coaching program sounds super amazing. So we'll have to give that some thought if we're in the right place to kind of do that. But we could talk about that offline. But anyways, I wanted to thank you again.
Yeah. Always willing to help with whatever we can, whether you're in our coaching program or not. We really are committed to impact and helping folks. So if you guys need anything or your listeners have more questions, definitely, get a hold of us and we can help with any of that.
Cool. And how can people find you, Julie?
So easiest way is probably just www.thejulieroy.com. Everything is on our website. Otherwise, socials, my name, Julie Roy, for most of them, or The Julie Roy. We're on Insta, LinkedIn, whatever the X is now called, and then Facebook. So yeah, you can pretty much find us anywhere. My husband is also in Pace Mortgage Group, which is a whole nother aspect of what we're doing. And so he does PML. So there's some private money lending he's working on and doing with my son. So we're kind of all involved all around.
That's awesome. Awesome. Well, thanks, Julie. I appreciate the time. I know you're busy. Keep killing it. Bring those investments on. Melvin and I will always be one of your investors for sure.
Well, thank you. And again, we just so appreciate your collaboration, your support, and your professionalism, your integrity. And we just are so thankful that you were able to have us on today. So thank you and have an awesome day.
Awesome. Same to you. Bye-bye.
Jacqueline and Melvin, thank you so much for taking time out of your busy day to listen to this episode of Get Diversified. Please make sure to subscribe to our podcast so you don't miss out on future episodes. Finally, stop by our website and follow us on social media. Ciao for now. Make it a great day, and we'll see you next time. And remember, get diversified.